Live from New York City for our viewers worldwide, I'm Matt Miller. A slew of economic data this morning doing nothing for markets. We're seeing very little movement after we hit an all-time record on the S&P yesterday. The countdown to the open starts right now. Coming up, stocks sitting at record highs with Fed speak in focus. We have a mixed bag of economic data doing little to move the needle, and Walmart delivering a beat thanks to price-conscious consumers. Let's start with the big issue, mounting signs of Goldilocks.
Retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are headed to Walmart to get that better discount. If we are at the start of a bumpy ride lower in inflation, a Goldilocks cooling in the economy, that's an environment that the market will welcome. What they don't want to see is a more rapid decline, and that's what we're on the lookout for. We don't see it yet.
Joining us to discuss now is Morgan Stanley's Katerina Simonetti, as well as Richard Bernstein of RB Advisors. I think we still have to talk a little bit about yesterday's data, not yet today's. Katerina, what do you make of the perceived slowdown in inflation, or I guess the actual data slowdown, although it's only obviously one data point?
Well, Matt, we will take any good news we can get. And of course, Fed is so focused on inflation, and we appreciate the fact that this is a move in the right direction, but we're nowhere close to their target rate of 2%. So what this tells us that they're very much still staying the course. We most likely are going to get few rate cuts this year, but the timing of it, that's really the question, because it's a data-driven Fed. That are going to look at the numbers. And as much as we appreciate the decline in the CPI, it was just marginally lower. And we would love to see, a better numbers. And I think Fed, is looking very closely at this before they take an action.
Richard, what do you think? I mean, encouraging, I think, is the way you described it in your note. Obviously, we've had other consumer confidence, labor data that hasn't been great. How do you see the Fed's position right now?
So Matt, I think the interesting point is in your preamble to this segment, there was a whole discussion about the soft landing. And I think economists continue to use the word landing and just refuse to consider that maybe the economy isn't landing, that the nominal economy is actually still strengthening. I mean, corporate profits growth is still revving up. You've had, inflation today. Yesterday we had an encouraging number, but today we had a discouraging number with import prices. The core import prices are up year on year now for the first time in, I think, 14 months. So I think there's still a chance that the economy isn't landing, that we're still in the process of accelerating to some extent.
But we have had, we have had earnings numbers, I think, that support that argument, Richard. 3 quarters in a row of earnings expansion after contraction for the previous 3 quarters. How does it look to you from a stock market perspective? I mean, we've already had a really decent run yesterday at an all-time high on the S&P.
Right. So Matt, I think the mistake that people can make right now is thinking about the market and thinking that there's one market out there, when in fact the market remains very bifurcated, where we've got sort of the Magnificent Seven, Fabulous Five, whatever it is, and then you've got almost everything else in the global equity markets. And I think the story that I think is the real investment story, the exciting investment story that's out there, is the broadening of profits growth, the broadening of the markets. I mean, in the United States right now, there are over 170 companies growing, or just in the S&P 500, growing earnings 25% or more. So is there anything unique about the Magnificent Seven? That's the question I think every investor should be asking.
And about the U.S., right? I think it's important that you mention that, because we see investors now looking for outperformance in other regions. Katerina, are your clients, looking to move out of the U.S. and rebalance a little bit internationally?
Matt, not so much, but I agree with Richard that as we decipher the earnings, it's really important to realize that some companies, especially the smaller ones, are really struggling in the higher interest rate environment and inflation that is affecting the margins. And others are seemingly very effective controlling their costs and staying profitable by cutting costs and being very frugal in the way they operate their businesses. But then there are also companies that are thriving because they're competitively positioned and there is a strong demand for their products. So we see the opportunity not so much on the US versus international level. We see the opportunity more on the stock, individual name level versus then even on the sector level. We continue liking materials, industrials, consumer staples, but it is really that differentiator that makes a difference where we look at the companies that are competitively positioned and are going to stay competitive, especially given the AI profitability factor, versus the companies that are going to be affected by inflation and high interest rate environment in the long run.
All right, so let's get back to that in a moment. Talk about stocks specifically, talk about sectors. Right now, though, I want to get to the economic data quickly because there was a lot out this morning and Fed speak continues to roll out as well. Here's the latest from Minneapolis Fed President Neel Kashkari.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
Bloomberg's Liz McCormick joins us now for more. And Liz, we've had, days of economic data that we're all watching today, a full page on EcoGo and more Fed speak. What do you make of the positioning right now, the FOMC?
Yeah, I think like Neel Kashkari was saying, many of them are signaling what the best policy is now is just to wait, right? They think they're restrictive, but they're not quite sure. It's kind of like do no harm is waiting. But the market is pretty much priced for that they'll cut twice. In the March dot plot, the Fed signaled, but it was an uber close call. The median was for 3 cuts. And I think the market believes that the next update in June will show 2. But like we have Loretta Mester speaking later today, and last month she had in an interview that she said she was at 3 cuts, but it was a close call. So, I think we're really watching, to see how much more hawkish the tone of the Fed speakers sound. But I don't think the market's willing to go too far over its skis yet because, we're kind of priced to perfection in a sense. 2 cuts seems reasonable. I know Bloomberg Economics says July is still a possibility. That's their call. We're very low odds for that. Most of the pricing is for the first cut to come in September. But yeah, we had a plethora of data today. It didn't kind of move the needle too much either way, but CPI, as we know, helped a little. So we're still in kind of wait and see mode.
Richard Tang over at Rocco says there's not going to be any cuts. And I have to chuckle at someone forecasting a move by the Fed in September, right? 2 months before a presidential election. Seems like something they wouldn't do. How can they move? Aren't their hands tied ahead of the, big political event?
Yeah, now, of course, Matt, Chairman Powell was asked that specifically at the last press conference. And as is his job, he said, no, we'll do whatever. But I think you're right. There's a lot of people calling it this jump risk. I think the folks at Bank of America said that if they don't get one in too soon, you're right, that September, of course, November is just not a good time. That's why, there's a decent amount of forecasters saying 1 cut this year in December. So I think you're right. Fed doesn't want to say, politics ever factors in. But it does get stickier as the election gets close. So, we have to see. I don't think, I remember talking to Richard Tang years ago. He's been at a few shops. There's many who say we might get nothing this year, right? And the Fed, waiting, let's see how it goes. They could be waiting and waiting and waiting, right? So, that's not impossible that there's none that come through.
Yeah. All right, Liz, thanks so much for joining us. Liz McCormick there talking to us about the Fed. I want to kind of get away from the parlor game of what are they going to do and talk about, Richard and Katerina, you both bring up, what companies are doing. But you can't obviously divorce yourself completely with whether or not Fed policy is restrictive. Do you see it that way, Katerina? Because certainly asset prices haven't been held back by Fed policy. What about companies' behavior?
Well, certainly we cannot divest ourselves from the news, especially that, given that this is all we're talking about. And investors are troubled by the uncertainty that all of this brings. And, they can't help but question what it means for their portfolio. And in our view, the biggest concern on the portfolio level is this unintended concentration that the performance of last year, and especially the Magnificent Seven, is bringing, because some companies, especially the large ones, are seemingly unfazed by the high interest rate environment. And some investors are finding themselves being concentrated in those names. And we can't forget that even though some of them are fantastic companies and it's easy to almost fall in love with them at some point, we can't lose track of the importance of diversification and risk management, especially right now when there's so much uncertainty about the Fed action.
Richard, what do you think? I mean, you mentioned the Magnificent Seven. Their earnings growth has been fantastic. If you take them out of the S&P 500, what you have left is pretty much just treading water. Do you like certain other sectors? Are they undervalued?
Oh, Matt, I think it's pretty easy to make the argument that most of the global equity market is actually quite cheap. That doesn't necessarily mean anything unless earnings are starting to accelerate. And I think that was my point before, that earnings are starting to accelerate. Value investors always want a catalyst. The catalyst is there. The question everybody should be asking, and this is something that Katerina sort of alluded to before, why isn't the market reacting the way it normally would? And the answer is, I think economists have completely missed the boat on this one in saying that the Fed is so restrictive. If the Fed is restrictive, since I'm on Bloomberg, why is the Bloomberg Financial Conditions Index showing that despite raising rates 500 plus basis points, financial conditions have eased? That's not supposed to happen. We see this every day. We see it in the meme stocks, tons of liquidity. We see it in the junk bond market. Spreads are very narrow. Institutional and financial advisors are daily being offered tons of private debt deals. Where is this tightening of financial conditions that would argue that the Fed has tightened too much and should be easing? I would argue it's the exact opposite, that despite 525 basis points, they haven't tightened enough to get financial conditions to tighten to meaningfully affect the economy.
It's easy to make that argument. I wonder if it's being made inside the Fed. Of course, Powell continues to say that policy is restrictive, but do you think there's a chance, Richard, for another rate hike?
I don't want to overplay my hand here because of some of the issues you were talking about before with the election, and they don't want to appear political in any way. Right. So it's not that there's that, but I think if you want to take a long shot bet, and I emphasize long shot bet, I don't think anybody should use this as baseline. Maybe the Fed's going to have to start tightening again. Maybe that's in early 25.
What do you do baseline after the run-ups that we've had, Richard? I mean, if you have new money coming into this market, how much of it do you put to work in stocks after, a 10+% gain year to date?
Well, I think to Katerina's point before, I think if you put it into stocks, Matt, using your word, and you put it into an index fund, I think you're going to be very, very disappointed, not only over the next year and a half, you could be disappointed for a decade. We could have another lost decade in equities because the index is so dominated by these large cap companies, these 7 large cap companies. However, if you're on the other side of the seesaw, so to speak, if you think of that analogy, I think the next, 1, 3, 5, 10 years could be very, very rewarding, but everybody's loaded up on the 7 companies thinking that AI is the wave of the future. We have to be there, everything else, and ignoring the breadth of opportunities in all these other sectors and industries.
Katerina, what's your take on if I give you new money to put into this market? Obviously we've run pretty far, pretty fast. On the other hand, people like Brian Belsky from BMO, who just raised his target on the S&P to 5,600, say momentum is hard to ignore.
Well, absolutely. I cannot agree more. And what we do not want to do is stay on the sidelines, because as comfortable as 5% yields in the money markets are, we have to remember that just a little bit over a year ago, we were looking at 1/10. And this is a variable rate. So the opportunity is in the stock market. Now, we absolutely favor quality. We favor large over small. We tell investors to expand their time horizons and have realistic expectations and stay true to their asset allocation. But this market might deliver returns that are not quite exciting as we have seen in the past, because inflation is here, higher interest rates are here, and they might be here to stay for extended time horizon. But there is still more of an opportunity to be profitable, on the side of the stock market than remaining on the sidelines and missing this. There is volatility, but there is also opportunities on the especially on the single stock names.
Single stock stories are what I think drive the interest the most. Katerina, thanks so much for joining us. Katerina Simonetti there, as well as Richard Bernstein, talking to us just 15 minutes ahead of the open today. Of course, we're already at an all-time high on the S&P 500, and let's get a look at what stocks are moving, which individual single stock stories are moving ahead of the opening bell. For that, we go to Abigail Doolittle. Abigail?
Matt, we have quite a few single stock names, big-time names, moving in a pretty big way. Starting off with the shares of Walmart. This stock, I believe, is on pace for its best day since July of 2020, up 5.8% right now after they put up 3.8% jump in same-store sales. They also boosted the full-year outlook just slightly, and it looks like wealthier shoppers are going to Walmart, really looking for essentials and discounts. Chubb also up sharply, up 6.9%. A bit of a mystery has been solved as Warren Buffett's Berkshire Hathaway was able to reveal a $6.7 billion stake in the insurer. It had been hidden before. The SEC had not forced them to reveal that, but now we do know that that is their stake there. And then Deere, the odd stock out, at least on this board, down 5%. They cut their annual profit outlook, and apparently, Matt, farmer demand is slowing the most since 2006. It's expected to be down 26% this year.
Yeah, farmer net income down 26%, the biggest drop in like 2 decades. It's a huge delta, and I think, such a fascinating story for Deere, but obviously Walmart as well. Everyone pays very close attention. Abigail, thanks very much for that. Coming up, we're going to hear from another person that people pay very close attention to. JP Morgan CEO Jamie Dimon speaking with us with Bloomberg at the bank's annual Global Markets Conference in Paris. We'll give you part of that next. This is Bloomberg. The JP Morgan Annual Global Markets Conference is underway in Paris. The CEO, Jamie Dimon, sat down with our very own Francine Lacroix.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I could point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around?
Yeah,
the next move?
I really don't pay that much attention to that. The Fed will have to follow the data. And I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance. My view is whatever the world is pricing in for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates, maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation's been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
That was JP Morgan CEO Jamie Dimon and Bloomberg's Francine Lacroix from the JP Morgan Global Markets Conference in Paris. Coming up, the morning calls, and then later we're going to talk to BlackRock's John Boivin joining us around the opening bell for his outlook on equities. This is Bloomberg. Taking a look at the pre-market here, a whole lot of nothing for the major indexes. The S&P unchanged, the NASDAQ unchanged as well. Both of these hit new records yesterday. The Russell 2000 down about 0.2%. It's been lagging the bigger indexes. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo initiating coverage on Texas Instruments with an underweight recommendation, seeing multiple headwinds to achieving the company's revenue targets. Next up, Truist downgrading Occidental to hold, expecting minimal shareholder returns given recent debt reduction plans. And finally, Wolfe Research upgrading Intel to peer perform, pointing to recent declines and improving gross margins. Very interesting as the chip maker kind of missed out, continues to get lapped on AI. Coming up, we're going to talk to John Boivin of BlackRock Investment Institute. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we're seeing a whole lot of nothing in terms of the index moves, but a lot of individual movers. The open in 12 seconds from now. One of the stocks we're going to be watching at the open, of course, is Walmart, raising its outlook after gaining market share from price-conscious consumers. They're seeing wealthier consumers move down. A different story over at Under Armour, under pressure after missing estimates. And we go back over to Abigail Doolittle. She's got more on UA. Abby?
Yeah, well, let's start out with the shares of Walmart. We're really looking at a tale of two stocks and retail companies here between Walmart and Under Armour. Walmart right now on pace for its best day since July of 2020. That's the degree of the buying power. And I think that investors are relieved that this company put up a same-store sales that jumped 3.8%, so very solid in the quarter that was. And looking ahead, they did boost that outlook a little bit, as you mentioned, just a little bit. And it looks as though, as you also mentioned, some wealthier consumers who may not normally shop at Walmart, they're looking for breaks and discounts. So that is helping to drive Walmart sales. It's interesting, though, their ticket price, 4.4% growth, was actually down on a quarterly basis, a sequential basis. On a year-over-year basis, there was a little bit of growth, but it looks like more of that was volume. As for Under Armour, we are looking at the worst day, actually just since March 14th of 2024 of this year, so about 2 months. So this stock has been under some pressure, and they, of course, missed their adjusted earnings forecast missed, but they're also talking about doing a restructuring that will include charges of about $70 million to $90 million that will also have some employee severance and benefit costs in there. So lots of uncertainty around Under Armour right now, down nearly 8%, down more than 8%, whereas Walmart enjoying a nice 5.7% boost on that strong quarter and outlook.
But also, Abby, I mean, hugely different scale, right?
Yes.
I mean, Under Armour has like 8,000 employees and Walmart has more than 2 million. I thought it was interesting that Walmart had a 22% gain in online sales. So a lot more people are using Walmart online, and it feels like that's the biggest driver of sales growth.
Well, that really speaks to the infrastructure that they put into place, over the last several years. Because when you think about Walmart, or at least when I do, I think of people actually going to that big box retail store and picking things up. But they have that infrastructure, and people want the convenience coming out of the pandemic. If they can get the deals and the convenience, they're going there. But point well taken on Under Armour, much smaller company, niche area, and perhaps the restructuring will help them achieve some of the moves that they're looking to make to boost numbers and probably the stock. It's success.
All right, we'll keep looking at it. Abigail Doolittle, thanks very much for that. We're going to have more on Walmart with Greg Melich of Evercore ISI in just a little bit. Right now, let's take a look at shares of Chubb, getting a big boost from Warren Buffett, the stock heading for its best one-day gain in more than 15 years after Berkshire Hathaway revealed a $6.7 billion stake in the insurer. Alex Semenova has more. Alex?
Hey, Matt, good morning. Well, the months of suspense over Warren Buffett's mystery stock are finally over. Berkshire Hathaway had previously kept this position private. The SEC had allowed it to keep it confidential in regulatory filings, and it now disclosed its stake in Chubb on Wednesday, a position it had been building since 2023 to the $6.7 billion stake that it is right now. Chubb's stock is up about 6% right now. That's no surprise given how closely people follow what Warren Buffett does. Berkshire is, of course, deeply familiar with the insurance industry, holding stakes in several companies in the industry, including Geico. If this gain holds, Chubb is set to hit its highest level on record. Shares were up about 12% year to date through yesterday's close. Bloomberg intelligence analysts said that this is a classic Warren Buffett investment, and Evercore ISI said that this is giving the stock a slight boost, given such a large investment at this point in the cycle. Matt?
All right, Alex, thanks very much for that. We'll continue to watch, obviously, everything that Berkshire Hathaway does. Let's turn back to earnings, though, and focus in on a company that I think we used to have a little bit more under the spotlight. Cisco, I remember when all we ever talked about was Cisco. They're giving a solid sales and profit forecast, indicating customers are beginning to invest in their computer networks again after Chuck Robbins has made a bit of a pivot. Katie Greifeld is here with more. Katie?
And initially, I mean, traders were pretty excited about this. Cisco shares were higher by about 5% pre-market, but that enthusiasm is going away right now. You can see shares down about 1.4%, even though, like you said, it was a pretty upbeat forecast when it came to sales and profit, like you said, suggesting that maybe that corporate spend is starting to pick up. Let's get into some of the numbers here. For the current quarter, forecasts were kind of in line with estimates. I would say sales will be between $13.4 billion to $13.6 billion. That compares with the average estimate about $13.5 billion. It's a similar story if you take a look at profit, expected between 84 to 86 cents a share. The prediction had been for 84 cents. For all of fiscal 2024, though, a little bit of a brighter story there. Revenue expected between $53.6 billion to $53.8 billion. Average estimate is for $53.6 billion. But the thing that the sell side has been excited about this morning, reading through some of the notes, is Cisco's progress on improving its relationships with hyperscalers such as Microsoft, such as Google. Of course, they had been really relying on their own in-house networking equipment for cloud computing. But when it comes to AI, Cisco now has a line of sight to $1 billion in orders from hyperscalers and others investing in AI. Again, that had been giving the stock a boost pre-market. Different story in the cash trade. You can see Cisco shares down about 1% or so. Buy the rumor, sell the news. Okay, thanks very much, Katie Greifeld, for that. Tune in to her interview with the CFO of Cisco, Scott Herren. That's at 10:30 a.m. Eastern right here on Bloomberg TV. Turning now to China, JD.com reporting stronger than expected profitability as Alibaba's profits were seen as weaker. Ed Ludlow joins us from the West Coast for more on Chinese tech stocks. Ed?
Yeah, good morning, Matt. We've actually had an interesting change of direction on JD.com. We're down more than 2%, having opened up higher by more than 2%. It's a story about basically retail strength. JD's top line growth was 7%. Compare and contrast with Alibaba's core e-commerce platform, which had pretty sluggish top-line growth of 3%. And we know that the story in the quarter, which included key Chinese holidays, was JD.com heavily discounting, cutting prices. But the bright spot in their earnings is also their profitability. It shrunk by less than expected, in part because of cost discipline. And, the narrative around the Chinese consumer, the reason we pay attention to both JD.com and Alibaba is that they're seen as bellwethers for the strength of the Chinese consumer and therefore the Chinese economy. What Alibaba had told us about 24 hours ago is that Chinese consumers have a lot of savings, they have a lot of cash, but it's a highly psychological or sentiment-driven market. And so therefore, it seems like we're learning the winners here. JD seems to be doing well in the online or e-commerce space. Analyst really flagging its strength in the electronics category, core retail categories. Alibaba didn't do as well. There is competition there from Meituan, Pinduoduo, and names like that. We are pairing our losses on JD.com. The other big story you will have seen on the Bloomberg terminal and Bloomberg.com is Michael Burry of the Big Short fame, right? Cyan Asset Management boosted its stake in JD.com by 80%, or its position, making it its biggest holding, but it's not doing much for the stock today. Alibaba, second biggest holding.
Ever since Christian Bale gave that amazing performance, I pay attention to everything he has to say. What is it, Cassandra on X? Cassandra?
Yes, exactly. Cassandra on X. Read the story and look at what he's been buying into in China.
I already read the story, Ed. It was among the most read this morning, and I go through that list pretty religiously. Ed Ludlow there from B-Tech. You can catch him on Bloomberg TV just after Katie Greifeld steps off the set. Joining us now is Jean Boivin, head of BlackRock Investment Institute, to talk to us about his outlook for stocks. And Jean, it's a new record that we hit yesterday, but we are still hearing people come out with even higher targets. I think Brian Belsky now says 5,600. What do you think of the overall of the index?
So we have been, overweight U.S. equities coming into this year. I think there are powerful forces at play that's going to drive returns. We've seen a very strong earnings seasons coming through. So the first part of this year for us was one that would be constructive. This is kind of playing out despite a little bit of wobble in April. So this is, I think this is in line with this broader context. We are still thinking, however, that a lot of it is driven by narrative about the macro environment, right? Inflation and so on. We've seen that yesterday, that was a trigger. And that is an extremely volatile narrative story. So I think that's the key lesson this year, is that this keeps changing. Flip-flopping, some enthusiasm now, but I don't think we can expect that to stay, stable through the rest of the second half of this year. And we think, the sum total of all that is we are in a higher rate environment for longer, even after the print yesterday. So I think this is constructive, but it's at the same time we're going to see some bumps coming from inflation not being as easily brought back down to 2% as we go through later in this year.
Yeah, so, John, I love to look at the single stock stories. I hate to get drawn into the macro debate, but you can't really help it when it looks like the market is placing a bet still on rate cuts, even though we're very far away from the Fed's 2% target, and we're in an election year with a Fed that doesn't like to get political. Is the market wrong here?
Yeah, so I think the market has been changing its mind pretty aggressively over the last 6 months, right? So since December, partly because central banks themselves have been quite a bit changing their tune. So I think now we've seen a Fed in particular over the course of the last few weeks that have sounded a lot more cautious on inflation being under control, a lot more hesitant. They can always flip-flop. They have flip-flop, but I think the bar for them to go back to their optimistic scenario is high. So as a result, I don't think July is very likely at this stage, even though the market started to get enthusiastic about that yesterday. I think the inflation story, even though this is a positive development yesterday, the inflation story is one where underneath all of it, there's a lot of persistence. There's a lot of persistence in services inflation. That hasn't been resolved. What we saw is an unwinding of the upside surprise earlier this year, but we have unwound to a level that is still too high in terms of service inflation. So I think it's going to be hard for the Fed to make a case of aggressive, quick cuts from here, especially how they've changed their tune.
Or any.
But it's not impossible.
I mean, loosening financial conditions at a time when financial conditions are already so clearly loose. What do you think about the corporate earnings story? I mean, Jess Metten wrote a great piece earlier this week about how analysts are pushing up earnings expectations after the first quarter was so well received, and we've had 3 quarters of earnings expansion after 3 quarters of contraction. But how does it look, for example, the S&P, if you take out the Magnificent Seven? How does the 493 look in terms of earnings?
Yeah, so I think this is still very much a concentration story, or at least that's the way we look at it. So we are, as I said, we're overweight U.S. equities. We've been positive on risk in this environment, but it's entirely based on the view that the AI, what we call a mega force, the AI mega force, is very powerful playing out, and we believe in that. So it's concentrated. That's what drives the market. I don't think we have a strong conviction on things necessarily broadening out. And when you see these quarters of earnings season like we've just gone through, there is momentum building up in earnings expectation that comes out. So I think you want to be a bit careful and extrapolating too much. I guess we shave some of these optimism to some extent, but very much believe on the concentrated story here on the AI, which will morph into something else beyond the Magnificent Seven. But it's not a broad-based macro story lifting all boats at the same time.
What about foreign stocks? I mean, I heard the argument on the MLive blog, Bloomberg's MLive blog made this morning, I think, that it's a great time to hedge against risk because we're in this Goldilocks environment, but you're going to see growth really more abroad than the kind of concentrated U.S. win story that we've seen lately.
Yeah, so I think, within the DM world, we are pretty excited about Japan. And I think that at this juncture, exactly, I mean, we believe in AI in the US, but diversification is important in this environment, particularly because we think this is an intrinsically more volatile environment. And Japan is pretty interesting in that context. On its own, I think has a very, bullish story that is with a central bank, unlike any other G7 central banks, that's going to be supportive of the market, in our view, for the quarters to come. And it has a micro kind of governance story that is happening as well. So Japan stands out and is attractive. And beyond that, I think, when you look on the relative valuation basis or just on valuation basis, EM stands out as well, the EM emerging markets. And when you think about tactically, but also more on a 5-year horizon, where valuations matter more, I think that starts to build to an interesting case. So yeah, I think there is now a building case for diversifying away from within DM, away from the U.S. maybe to some extent, even though U.S. is attractive, and away from DM to EM.
Jean, great to get some time with you. Thanks so much for joining us. Jean Boivin of the BlackRock Investment Institute. Coming up, price-conscious consumers flock to Walmart.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail.
Good for Walmart. The shares hit a record high. We're breaking down the numbers when we come back. This is Bloomberg.
I think the real story here is actually below the top line, though. We started for the first time in a long time really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print and probably was a pretty tough quarter for retail in the first quarter. I mean, we'll get more results in the next couple of weeks, but we're pretty happy with the numbers.
Walmart benefiting from a more cost-conscious consumer, and I think online sales as well. Pretty amazing. Walmart shares hitting a record high on better than expected results, with upper income households driving the gains. Joining us now to discuss is Evercore's Greg Melich. He has an outperform rating and a $67 price target on the stock. Greg, I think it's a fascinating story, especially for me, the juxtaposition with Amazon, because, you know, pre-pandemic, Amazon was a cheap place to shop, and I have a very cost-conscious wife. Now, Amazon's prices have been floating higher, and she's started to look at Walmart online, which I always think of Walmart as a place you walk into and hang out in. Is that a huge part of the same-store sales growth that we've seen?
It's a big part of it. And I would say, and even Amazon recognizes this, the U.S. consumer is extremely focused on value. And so whether it's Amazon trying to get more products to people faster, Walmart is doing exactly the same thing. And they're really leaning into their strengths, which have always been that strong value, and now layering in convenience and speed of delivery. And that's bringing new customers to them, and customers they had before coming more frequently, shopping categories that maybe they haven't before at Walmart. So they're sort of winning on three fronts. And that's why it's one of our top names and has been this year.
Abigail Doolittle was pointing out earlier that, you know, sequentially they had a change in the average ticket price, but if you look year over year, it's zero. How do they do that when inflation is so much higher?
Yeah, average basket, that 3.9 comp is particularly impressive when you consider that it's all traffic. And that's positive traffic on traffic a year ago that was up, I think, 2.5%, 3%. So that, to me, is the core underpinning of Walmart. It's you're getting more customers coming more frequently. You know, what inflation is going to be what it is. And they're doing as good a job as they can is trying to suck that out of the system. So overall inflation, and the same SKU inflation in the basket, they said was just 40 bips in the quarter. So that's a couple hundred bips below overall U.S. CPI. So Walmart's doing their part to try and squash inflation. But at the end of the day, there's only so much you can do. But they're as a result, their strong value proposition is just winning more customers.
In terms of the consumer, I mean, it's great if you can get consumers to move down, I guess. But ultimately, you want growth in all of the segments. Can they do that? Can they keep doing that?
I think you can. I think it's not the key about the Walmart story, and to me why it's changed so much in the past 12 to 18 months, is it's no longer about just getting trade down or like people that have to go to Walmart. They're people that want to go to Walmart. It's having 400 million SKUs available through third party on Marketplace. It's getting Walmart Plus memberships to grow. It's getting people to sign up for Sam's Club. Sam's Club, again, you showed the numbers there before, but that was also a comp that was about 100 bips better than we thought. So they're using technology and their strong, historic, low-cost, everyday proposition to bring convenience and speed to consumers, and that's resonating with all income groups.
I'm zooming through your bio on the Bloomberg here, Greg, and looking at the stocks that you cover. I don't see Amazon here. Do you think of the two as direct competitors? Would you choose one over the other?
Well, my partner on it, Mark Mahaney, our internet analyst, we agree that it's a good, Amazon remains a winner. We've got an outperform on it. In our top 5 portfolio, though, I would say that we run across retail. We don't have Amazon in it, even though we think it has nice upside. We think the risk reward on Walmart here is frankly better. At least that's my opinion. And I think it's not an either or. I mean, both combined now, Amazon is up to about 10% U.S. market share of retail, gross market value, and Walmart's about the same. So we could be sitting here 3, 4, 5 years from now talking about, wow, how did we just miss that Amazon and Walmart went from a combined 20% share of U.S. retail to 25 or 26%.
All right.
So to me, it's not an either or. They're both showing that if you put together good prices, great assortment, and faster delivery and speed to help the consumer, that resonates with everybody.
All right, great to get some time with you, Greg. Thanks so much for joining us. Greg Melich there over at Evercore ISI. Let's get some breaking news now. For that, we go back over to Abigail Doolittle. Abby?
Indeed, Matt. We do have the shares of UBS trading down about 1.4% amid the headline, the breaking news that UBS, considering a U.S. CEO role for Rob Karofsky, who is currently their head of their investment bank. This is to compete more so with some of the other big banks on the wealth management side where there are annuity-like returns. We don't know that this will happen yet, but UBS is considering a U.S. CEO role for Rob Karofsky. It would be a big strategic revamp.
Got it. Abby, thanks very much. This is Bloomberg. Here's your trading diary. Fed Vice Chair Michael Barr testifying before the Senate. That's at the top of the hour. More Fed speak throughout the day with Harker and Mester on deck. And the J.P. Morgan Global Markets Conference continues in France. We'll have interviews out of that for you. Finally, we round out the week with Richemont earnings. We'll see how many expensive watches rich people continue to buy. This is Bloomberg.